In this video, what I want to do is go over the classic butterfly trade. This is not going to be a complete comprehensive class on the butterfly, but I do want to go over the basics of it, and we're also going to compare it to the iron butterfly and the split strike butterfly real quickly. But I wanted to give this basic introductory video to see, so you can see how it works and some of the dynamics behind it. So if this is the first time you're doing a butterfly, or if you're thinking about doing a butterfly and you put it on, you can see exactly what you need the stock to do and how it works and how the options intermingle and make stuff happen. So what I'm looking at on the screen here is a trade that we did for the Option Genius portfolio in J&J, which is Johnson & Johnson. This trade is currently over. We got out of this trade a couple days ago with a very nice profit. I think it was somewhere around 20%. 20% gain on this trade. And if we had stayed in the trade, we would have made a little bit better than 20%. Because as you can see, this is 6506 is where the stock is trading right now, and that is where our short strike was. So this trade is like perfectly dead center on the money, and it's making continue to make money for people who did not get out. But like I said, I hit my profit target and I got out. So basically, let's go through the trade itself. This is a classic butterfly. A classic butterfly is a three-legged trade, so it has three options. It has what they call the short strike, which is the middle strike. The short strike, which is in the middle, and in our case, it was the 65 because that's where the stock was trading at the time. And you can take a look at the chart real quick. So as you can see, these are the two break-evens that we put the trade on, but the stock was trading right around 65, and that's where I wanted to center the trade. And so that is what I chose for the short strike. So I looked for a butterfly to put on at the short strike of 65, and then I went out 5 points on either side for my other options, which are called wings. So this was the middle, the 65, and then one wing was at 60, and then one wing was at 70. And that gives us our little triangle-shaped chart, as you can see here. And then based on the price of this, it gives us our break-evens, which were 63.27 and 66.72. And that is how I got these two red lines here on the chart. Now, a classic butterfly consists of selling the at the money strike and then buying the two wings. Now what happens here is one of the wings is going to be in the money and one of the wings is going to be out of the money, and therefore the wing that's in the money is going to cost a lot more than what you're selling the at the money strikes for. And so this trade is going to result in a debit, meaning you're going to have to pay for this trade. You're going to have to actually give money to get into this trade, and that means that the money that you pay for this trade is the maximum you can lose. It's also called your margin. So it's your max loss going in, and then when you analyze it, you can actually determine what your max profit would be. And in this case, it was somewhere around $331, give or take. These numbers will vary as the market changes. As you can see, the lines are moving around. But $330 was approximately the amount, the max gain, and that was if the stock was exactly at 65 on expiration day. Now, I've never seen that happen in my years of trading butterflies. So normally what I suggest is to aim for a nice profit of maybe 10, 15, even 20%, and then get out. So you don't need to wait until it gets all the way to the top here. As you can see from our blue line is telling us what the profit is right now. So it's, you have a nice blue line moving up and down. That means you have a good profit in the trade. But to wait for that blue line to get all the way to the top. It's not recommended, and in fact, as the time gets closer and closer to expiration, it'd be very easy for the stock to move even a little bit, and you'd be outside of the triangle. So just don't do it, you know. I mean, you can try it if you want to on a trade just to see how it would work out, but normally you want to get out when you hit your profit target anyway. So let's get back into this. Now, the debit that we had paid for this trade was $328, and now this is the debit for a single fly. As you can see here, we did a 242, which is 2 different butterflies. So now if I had, let's change this a little bit, this would be 1 butterfly, a 1-2-1, and that would cost us $328. Now since I did 2 of these, a 242, my cost on the trade, my margin, was double this. So 328 times 2, my cost was $656. That's how much it cost me to get in the trade. Now right now, according to this chart, it's showing us that the profit, if we were still in the trade, we would be making $165. So 165 divided by 656, we'd have a profit of about 25% if we were still in this trade. And we got out a couple of days yesterday. Got out a couple of days earlier with the profit of 20%. So if we still stay in the trade, we could probably make a little bit more as long as it stays inside the break-evens. But that is how you calculate your margin, and then the margin is the most you can lose. Now, how does this trade actually make money? Basically, what you want this trade to do is to stay as close to your short strike as possible, in this case 65. It can move around a little bit, but then you won't make as much money. As you can see from our little triangle, the red line, look at the number here. If on expiration you were somewhere around $64, you'd only make $149. If you were at $66 at expiration, you'd make $147. But if you were at 65, you can make $324. So there's a big change, a big range in how much you can make. Now, if you go outside on expiration, then if you go outside the break-evens, then of course you could lose money, and then up till down, and then the maximum you could lose is that 656 that we talked about. Now, since this is a debit trade, you're going to pay money to get into the trade, but that means that in order to take your profit, you have to actually get out of the trade. You cannot let it expire. It's not a credit spread type trade where you actually get paid and then you can let it expire. This, you actually have to pay to get, you have to exit the trade. When you exit the trade, you'll get a credit, and if the credit is higher than your debit, you have a profit. If the credit is less than your debit, then you lose money. Basically, that is how the trade works, and it works because you have a lot of time value here sitting at the money. And what you basically want it to do is you want the stock to stay in this range, and as time goes by, the theta on your trade will work in your favor. Now the theta on this trade is about $8 points, or $8. So that tells us that if Johnson & Johnson doesn't move from this spot, you're going to make another $8 tomorrow, and then the theta will increase because you're getting closer to expiration. So you'll make another maybe $8, $9, $10 the next day, and then a little bit more the next day, and then a little bit more the next day. So as long as the stock doesn't move, you're making this theta every day after day after day after day until your profit is high enough that you can get out of the trade. The out of the money and the in the money longs, because of the time value, don't lose as much in theta decay as your shorts do. So that's how the trade works. So you want it to stay as close to the middle as possible, and then if it moves around a little bit, that's fine. If it breaks out of the break-evens, then you need to take action if you're convinced that it's not going to come back into your profit zone. And then the big thing to be concerned about is don't be greedy, get your profit target and get out. Now that is the classic butterfly. Now, what I want to do is show you another way to do a butterfly. Now this is a 4-legged butterfly, and it's called an iron butterfly. And as you can see from the graph, it looks the same exactly as our classic butterfly, but this one has 4 different options. What's the difference? Well, as you can see here, you have 2 different credit spreads. This is actually called an iron butterfly because it's made up of calls and it's made up of puts. You can actually do the same trade in all calls or all puts, and it would just be called a 4-legged butterfly, and it would not be called an iron butterfly. This is called an iron butterfly because it's made up of calls and puts. That's why you have called iron. So what you're looking at here is you have the short strike for the puts at 65, and then you have another put long at 60, and then you have the short call at 65, and then you have a long call at 70. That's what gives us our little triangle that looks exactly the same as our classic butterfly. In our classic butterfly, we used all calls. You can also use all puts. It doesn't really matter. The prices are about the same normally. So it doesn't really matter if you use calls or puts. And if you do an adjustment, you can do the adjustment in calls or puts. It doesn't make a difference to the trade. So if you look at it here, you basically have the same thing that we're sitting at here. If you just see this is a 2, this is a 4, and this is a 2. So you have sold 4 65s. So if you say you sold only 2 65s, you have a spread, you have a call spread, and then you have a lower call spread. So if this was a put, then you could have, well, this wouldn't be a put, but you could basically, this is identical in the sense that you have 4 sold at 65, and you have 4 sold at 65 here. And then you have 2 at 70, and you have 2 at 60. Again, here you have 2 at 60, and then you have 2 at 70. So these are basically the same trade. They work in similar formats, but as you can see, this is a credit trade. This is not a debit trade. This is a credit trade. And so because it has 4 legs and it's made up of calls and puts, the adjustments here would vary. And the thing to be careful here is you will still, even though this is a credit trade, you still want to exit this trade because you don't want to be in the money and get exercised at expiration. So since you have the shorts at 65, if it's at 64, and a half, you'll get exercised on one side. If it's at 66 on the other side, you can still make money, but you're going to get exercised on the other side. So it's best to exit this one as well, even though it is a credit trade. So be careful of that. Now we also have what's called a split strike butterfly. Now let's look at the chart on that. Okay. Now this, if you are familiar with iron condors, looks a lot more like an iron condor and not like our little triangle regular butterfly. Now, why is this called a split strike butterfly? Well, it's basically a matter of what you want to call it. You can call this an iron condor if you want. You can call it a butterfly if you want. Basically, an iron condor, if you know, is made up of 2 credit spreads. So you have a call credit spread, you have a puts credit spread. So this trade that I showed you right here, the iron butterfly, can also be called an iron condor if you center the short strikes at the money. And that's what I did here. And as you can see here, when I made the order, I had to do it as an iron condor. So this could be considered an iron condor. And that's why the split strike looks very similar to an iron condor. Now, the only thing I did here was I moved out one of my strikes. So I have my call, I still have my call at 65, just like I have it here. Well, let's make these a little bit the same. So our longs would be the same. Put this at 65. Okay. So now our longs are exactly the same. What did I do? No, I messed up. This was supposed to be 62.5. And, well, let's make this 60. And let's make this 65. 55. Okay. Oh, shucks. I should have just left it the way it was. Now it looks totally all spread out. Let's go back to where it was. Okay, so it's a little bit off, but I don't remember what I had exactly, but so here we have our call short strike is at 65, same as the trade above, but our put short strike is 62.5. And then our longs are at the same, at 70 and at 60. So now the only thing this does is it makes the trade a little bit longer. It gives us a little bit more room for this to run. The range gets a little bit bigger, and you want to do that just in case. I mean, you have the option of doing it if you think that the stock is going to move around a little bit more. Now notice this is also a credit trade, just like the Iron Condor. So in this case, if at expiration J&J was in between your short strikes of 66 and 62.5, so let's say it was at 63 or 64, if it was at 63, it would be right here. You could actually let this trade expire. You wouldn't have to do anything. So anywhere between the break-evens of right here, which is 62.44, and somewhere around here of 65. If it's anywhere between there, you can actually let it expire worthless, and you won't have any problems. So that is called a split strike butterfly. The only difference is that both of the spreads are not centered at the same short strike. One is a little bit different. Now, if you wanted to move this out from, let's say, 65 to 67.5, then you pretty much have an Iron Condor, and it looks just like that. Now, it wouldn't be that because you have no profit here, but you know, you're making the trade wider and wider. So you go from a classic butterfly, which is a triangle, to something that's more of a condorish table type trade. So those are 3 different types of butterflies. It depends how people, to determine which one you use, it really depends on what you think the stock is going to do, and how familiar you are with the actual adjustments, and which adjustment you feel more comfortable with. Most cases, if I think the stock is range bound, I would use a classic butterfly because it's very easy to adjust. All you have to do is add a second butterfly if it comes out of your profit, your break even. If it breaks the break even, you can add a second butterfly, and then the trade gets wider. An adjustment on a iron butterfly is simply to roll one of your sides up. So let's say if it breaks the break even on the high side, then you would have to just roll the calls higher. You can go from 65 to 67.5. And as you can see, well, let's do that again so I'll show you in more detail. So right now here, on this, the way it's set up here, your break even is right here at 65.86. Now let's say the stock moves up and it goes past 65.86. The simple adjustment would be to change this. You buy back your 65s and you sell 67.5, and that just extended your break even all the way out to here, which is 67.62. So that is a simple way to adjust an iron butterfly. Okay, so if you have any questions, feel free to email us. I hope this basic introduction video on the butterfly made some sense. And if we need further explanation, please email me, and then we can make additional videos or expand on any particular topics. All right, have a great day, happy trading, and talk to you soon.